What if a few simple tax moves could save retirees thousands of dollars? Well, today we are breaking down the essential items on your tax season checklist so you can avoid surprises, preserve your income, and most importantly, keep more of what you've earned. And to guide us through the do's and don'ts is our host and certified financial planner, Adam Wolf. Adam is the president of Wolf Retirement Navigation right here in Jacksonville, Florida. You can learn more at wolfretirement.com. Adam, always a pleasure.
Great to see you.
So I have to say, as soon as we start talking about taxes, my palms start sweating. I have like PTSD from tax prep.
Uh-oh.
So walk us through the tax season checklist. What do we need to do so that our palms aren't sweaty?
Yeah, I hear about taxes and I'm like, okay, we don't want to pay them, but it's extremely exciting for me because I like to save money in taxes for not just myself, but all of my clients. Yeah, so this is the time of year. It's tax season once again. Had my first tax season. I was paid a fee for preparing a tax return and an internship I did in 1999. That was the first tax season. So
wow,
they seem to want to get easier every year, but sometimes they don't necessarily do. But anyway, what we do for our clients, our financial clients, we offer tax preparation services because we do a lot of tax planning. And one of the biggest expenses in retirement is the federal tax bill. So anything we can do to save money in taxes, not just this year, but over your lifetime, is what we like to do and like to accomplish. It's a big, big deal. So yeah, a couple items on the tax season checklist is pulling all the information together. That's sometimes easier said than done. So your W-2s, your 1099s, your all of your, 1099Bs and interest statements and Ds and things. And now for our clients, for our Charles Schwab is where we custody all of our clients' assets. We have all of that information for our clients. So you do not have to send that information in. But for everything else, some of the folks out there want you to download them. Some still send them in the mail, but just pull it all together and make sure that whatever you're working with, you have a pension coming in, Social Security coming in, you have a credit union account, or maybe 2 bank accounts where you have interest earned, those types of things. You need to start pulling them all together to make sure you have a accurate inventory of your information.
Is it a good idea to start with a checklist of where you should be expecting to get tax statements from? Because for some people, as you mentioned, they're coming from a lot of different places. You don't want to start doing your tax paperwork and then realize halfway through it that you're missing some information.
Yeah, great. For our clients, we send out tax organizers. We did that 1 to 2 weeks ago. For most people who should have received them in a mailbox about 1 to 2 weeks ago. And it gives an organization to what you had last year. Doesn't mean you'll have it this year, but a lot of times it's overlapping. So if you're working with another tax advisor or CPA, or you work with, hey, you have your tax software, that will be the first place to start, because that's usually, hey, what did I have last year? Then I can sort of check off what I had last year, what I have new this year, to have a full accounting of it all.
And you mentioned that we often think of taxes as just a season. Oh, we're heading into April, we got to do tax season. But tax planning is a lifelong plan. We are trying to avoid paying taxes over the long haul. Talk to me a little bit about when people should start having the conversation, not just for the year, but as part of their retirement plan as a whole.
Yeah, you just start having like the tax conversation in your 50s if you're still working, while you're still working, to get a handle on what it's going to look like when you're retired. To, going from those years of making income, if you're married, your spouse having income as well, what you're going to look like when you're no longer working and where your income sources are going to come from, to get a handle on what your bill's going to be, your tax bill. Then what we can do, once we have that baseline, we can get a sense of what strategies in place can be done now and over the next multiple years to move money from tax deferred or taxed as you go accounts to tax free accounts that will, growth is no longer taxed and distributions or withdrawals are no longer taxed. That's really, in a nutshell, a lot of the tax planning that can be done over the long haul, is pushing money and assets into a tax free bucket to be able to use that in the future when the government raises these tax rates and raises the income levels associated with the tax rates. So it's just proactive planning, Alyssa. That's all it is.
One of the other things that always comes in as part of the conversation when you're having tax conversations is RMDs, those required minimum distributions. Are you a proponent of planning that as start of the year and then, goes out monthly, or you like one lump sum? How do you approach that when it comes to taxes?
It's all about what the client wants. So there's ways to do it. Well, number one, let's talk about so required minimum distributions. Right now, if you have reached age 73, if you turn 73 this year, you'll need to start taking it out. The current rule is by April 1st of the following year. So if you turn 73 this year, then you need to take it out by April 1st of the following year. But I tell all my clients, at least the majority of the time, go ahead and take it the year you turn 73, because what happens if you take it the next year? You have to take two. And what
Mhm.
it is, you pull all your balances together in your IRAs, your 401ks, and you see what that dollar amount is for the total. And then you divide it by a divisor that's based on your age. And so for the first year you take it out, it's going to be roughly 4% of the balance. So it's not going to be a whole heck of a lot. And for a lot of people that I work with, Alyssa, they're already taking out money out of their IRAs to live off of at
Mhm.
that age. So it's a moot point for many people. Now, those RMDs are extremely important to plan for, because if you don't take it in the year you're supposed to, because you're supposed to take it at age 73 and then every year afterwards. It used to be age 70 and a half, and then it was 72, and then it's going to be going to 75. So we have to know the rules first off. But second off, if you do not take it out and you do not file right now, you could file a form with the IRS to say, hey, I beg for forgiveness, do not penalize me. But the penalties can be pretty steep as well if you don't
Mhm.
take the required minimum distributions out of your IRA. And a lot of times people ask me with Roth IRAs, tax-free IRAs, are there RMDs? There are not. So as long as you own it, if you're married, your spouse inherits it, she owns it or he owns it, then there are no RMDs on those Roths. Now, non-spousal folks, beneficiaries, maybe the kids, the nephews, the nieces who would inherit this stuff, they'll have to take an RMD on it in the future. So just know the rules and get ahead of it, and therefore you won't get in a lot of trouble. Or and you follow the rules and you limit and reduce and minimize the taxation over time.
2026 brought with it some changes. We had the big, beautiful bill that passed last year that will be affecting people for the first time this April. What are some things that retirees in particular should be taking advantage of with these new bills?
Yep, two things, at least two things to start. One of them is the Social Security deduction. It's called the senior deduction. I like calling it the Social Security deduction. And so, I just don't like the word senior unless we're getting a deep restaurant or something. It's an additional $6,000 in deduction, not a credit. It's an additional deduction. It's not as part of your standard deduction. It's totally separate. So you'll get another $6,000 per person. If you're married, that's 12,000.
Mhm.
So if you're filing as single, it starts to phase out, meaning they start to reduce that $6,000 deduction once you hit $75,000 of adjusted gross income. So that's all the other income you have for the most part. There's some exclusions there. And for married filers, it is 150,000. So the government say, hey, everybody, we're going to give you a little bit more, but we start to phase you out. So know those rules there. Number two, an interest deduction on a car, automobile, not just cars, but automobile loans. So loans on your automobiles, if you take out a loan, I'm not an advocate for taking out a loan, but if you do, that interest in 2025 and every year up to 2028 is going to be deductible. And so up to a max amount of 10,000. And also, if you're a single filer, you have to have AGI under 100, married under 200. So doesn't necessarily mean you do or don't take a loan. Give us a call for that. We can help crunch the numbers for your specific situation. But if a loan interest rate is 7%, I'm gonna make up a number right now, and you're getting a 22-cent savings on that, you can bring that 7% down to, 5 to 6%. And that can be some of the math that you use when you make that decision to take out a loan or not take out a loan. So we'll help crunch that number with you, but it's deductible and it's not considered an itemized deduction. So you'll be able to take it in addition to the standard deduction.
Mhm. Whenever we think about doing our tax planning, there are always things that are easy to forget. What are those easy to forget things that you want to make sure retirees include as part of their tax prep for the year?
Yeah, so a couple of the ones that are not included all the time is, did I make estimated tax payments? And those are tax payments you make along the way. There's a couple ways to give the government your money. So one of them is having it withheld from,
Mhm.
your forms, or, from your W-2s and from your 1099s, and having the company send the money directly. That's one way. That's a lot of times the easiest way. Other times is doing estimated tax payments, and those are done quarterly, and they're supposed to spread out the payments throughout the year so the government receives our money throughout the year. Because if you don't pay in enough based on what you owe, then you could be subjected to penalties and interest. So that's something that, hey, I have some clients that maybe life got in the way and they made the
Mhm.
first two of the four estimated tax payments and didn't make the fourth and third. So make sure that you pull that information together. But in the organizer, we do ask for that information. And also, making sure that if you're working with a custodian, like say you did a one-off distribution from your 401k or your 403b, making sure that you had that 1099, especially if you are no longer working and you still have that plan, but maybe you moved or maybe you have a different address and they didn't get that address to you properly. So that could be something that slips through the cracks. Now, if you're working with us, we're helping you with that stuff. So we're ahead of the game. Just make sure that the one-time things that you did do in 2025 are that they are sending you the proper 1099s for.
If someone's listening to this and realizing, it sounds nice to have someone on my team that helps me prepare this stuff, what can they expect in a first consultation with you?
We help our current financial clients and then friends of our current financial clients. If not, we'd be doing way too many tax. Martha would be so inundated with tax returns preparation that it would just be overwhelming. So we limit it to make sure that we have enough focus and enough time spent on each client. So the question is, if you come in as a client, yes, it's getting the organizer and sitting down and pulling it all together.
Mhm.
And, when we're meeting with financial clients for the first time and going through that process, it's great that they hear that we have an add-on service that's included that says, hey, we're going to help you with the tax planning, but also because we know the numbers, but because we're also going to help with the preparation of it to be one less thing you have to worry about. And it's funny, I have like one or two gentlemen who still love doing their own return, which is wonderful. One of them actually does it by hand, which is just insanely awesome.
Wow.
But they want us to do it as well to see, how his numbers are stacking up. And I could see one of these days, it's not going to be necessarily soon, but it's going to be one of these days he's going to hand it off to us to help with it. And so it's so that through that consultation, we say, okay, were there any, you know, big extraordinary items that happened this year, or if you're new to the company, or you getting ready to retire. So we talk all through life and then how that looks from the preparation perspective. And then from there, once we get through a tax season, we start the planning process to say, how do we reduce this taxation over time now that we have a really good baseline with the taxes that we did in the current year? So we have a really good baseline for the projection to say, how can we save money, save taxes over time where we can to keep more money in your pocket.
Well, if today's checklist sparked questions about your own retirement tax strategy, again, you can reach out to Adam for guidance that is tailored to your situation. Tax planning doesn't have to be stressful and make your palms sweat like it does me if you have a good team on your side. Again, you can head on over to the website, which is wolfretirement.com. Schedule that complimentary consultation today. And of course, be sure to subscribe wherever you're listening so you never miss an episode. Thanks for joining us.
Investment advisory services offered through Coil Capital LLC, a registered investment advisor. Wolf Retirement Navigation LLC and Coil Capital LLC are not affiliated. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining values. Opinions expressed are subject to change without notice and are not intended as investment advice or to predict future performance. Past performance does not guarantee future results. Consult your financial professional before making any investment decision. This information is designed to provide general information on the subjects covered. It is not, however, intended to provide specific legal or tax advice and cannot be used to avoid tax penalties or to promote, market, or recommend any tax plan or arrangement. Please note that Wolf Retirement Navigation LLC and its affiliates do not give legal or tax advice. You are encouraged to consult your tax advisor or attorney. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurer. Any references to protection or benefits or lifetime income generally refer to fixed insurance products. They do not refer in any way to securities or investment advisory products or services. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and not offered by Coil Capital LLC. Florida Insurance License Number W016816.